Hello, good afternoon. You're watching News 9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. In the studio with me is Suyash Maheshwari. Suyash, good afternoon.
Good afternoon, Shweta.
Let's quickly run our viewers through how markets performed this afternoon.
Certainly. So after a flat opening, markets also closed on a flattish note, but with a negative bias. So the market has snapped its two-day winning streak. Now at open, Nifty was up about 19,800 levels or so. The index has faced during the session resistance at around 18,850 levels, and we also saw it dipping towards that 19,780 sort of levels. However, the index did manage to recoup some of the losses in the last half an hour or so, but on a closing basis, the index has closed below the 19,800 mark. Now, Sensex also saw a slight correction of about 50-60 points, and the index closed just above the 66,400 mark. The broader market, Shweta, today outperformed both the headliners. Nifty small cap index was up about 0.65% in today's trade, whereas Nifty mid cap 100, Shweta, ended with gains of about 0.2%. We also continue to see a decline in volatility. India VIX today declined by about 3.34% and currently sits at about 10.62 mark. Now, among sectors, Shweta, we saw a correction across IT stocks. The IT pack, in fact, was the worst performer today. The index corrected by over about 1.67% or so. And most of the heavyweights saw a deep correction where led by Infosys, which was on 2.8%, TCS, which was on 1.85%, HCL Tech, which was on 1.78%. Now, among other sectors which were under pressure today was the Nifty PSU Bank. We have seen the kind of the rally that we saw in the initial few months of FY24 kind of fizzle out over the last few weeks. However, Nifty Bank maintained its bullish momentum. The index has gained about 1.6% or so in the last two sessions. In fact, it also closed above the 44,500 mark, inching towards that 44,600 mark on the daily charts. Now, another loser today was realty stocks. Nifty Realty, which is currently at a 15-year high or around the 15-year high, saw some profit booking taking place. The index was down about 0.18%. Auto stocks outperformed. The Nifty Auto pack was up about 0.8%. FMCG pack was muted. It was up about 0.21% or so, whereas media stocks saw some good buying action as the index ended about 3% higher in today's session.
All right, and since we are talking about IT, and the whole IT pack of course continues to be in the news for the entirety of this week, we're hoping our guest will join us very, very shortly. But let's quickly get a sense of the results that have been out so far and what is expected as far as Infosys's results is concerned. We're given to understand that they will be out any time now.
Yes, Infosys results are expected any time now. I mean, on a sequential basis, the expectation is that the performance will remain muted, and we'll see a marginal decline on a quarter-on-quarter basis, whereas profitability is expected to improve because there is no wage hike cycle, and the companies have also worked towards cost optimization.
All right, that is as far as Infosys is concerned. HCL Tech results are also expected.
HCL Tech's results are also expected, and I mean the expectation is that we'll see a sharp recovery in both revenue and profitability, given that the company has presence in the cloud business more so than its competitors TCS and Infosys. So the expectation is that we'll see a sharp recovery, but the stock, Shweta, in the run up to the Q2 results has corrected significantly. It is down about 3.5 or 4% in the last two sessions. It was down about 1.6% yesterday. In fact, today also it ended about 1.8% lower. So I mean the street is not very bullish on the prospects of Q2 results of HCL Tech, it seems.
All right, and so far the sentiment is that many of these companies are going to miss their margins and revenues targets, and even if the volumes look very lucrative in terms of the deals that have been signed, there's not enough margin to go by. That of course is the big message that we have picked up from our experts, people we have been speaking to for the last 24 hours.
I mean that is the broader trend, but as far as Q2 being a muted quarter, the expectation was there and it has been absorbed in the prices of the stock, as we have seen a fair bit of correction in the run up to the Q2 results. But Shweta, the focus, I think, this quarter especially will be on management commentary, especially in regards to the deal wins, because of course the companies have landed big deals in the previous quarter. We have seen Infosys landing deals to the tune of 5.5 billion, HCL landing that Verizon deal of about 2.1 billion dollars, TCS also adding deals of about 3.6 billion dollars. But the problem, Shweta, remains that all these deals are long duration deals, so the revenue realization will probably not occur in the next few quarters, and probably by the first or the second quarter of FY25 we'll see the effects of the big deal wins start trickling in.
All right, and since TCS results came out and we tried explaining to our viewers the big takeaways, let's also quickly run them through those takeaways.
Certainly, Shweta. So TCS on a it was a mixed bag quarter for the company. On a quarter-on-quarter basis, the revenue declined. Not declined, but came below the expectations of the street. Now the street was expecting revenue to increase by about 1.3% sequentially. However, revenue came at around 0.5% higher on a quarter-on-quarter basis. If you are talking about net profit, we have seen at least in terms of realizations, the profit exceeded the street expectations, and this was on the back of company optimizing its cost, streamlining its processes, and also we are not seeing any sort of hiring this quarter. So perhaps that was one of the reasons why profitability and margins improved. Okay, so TCS revenue, as you can see, was up about 0.52% on a quarter-on-quarter basis. Shweta, this was below the street's expectation, which was pegging it at 1.3% or so. Net profit, Shweta, improved significantly. The street was expecting around a 0.8% quarter-on-quarter improvement in the net profit figure. However, it came much ahead of the expectations and it improved by about 2.42% from 11,074 crore in Q1 of FY24 versus 11,342 crore in Q2 FY24. Now, operating margin, Shweta, we saw a good bump up there, 110 basis point bump up in the margins, but I was reading some commentary coming in from the brokerages this morning. They are, concerned about the revenue growth of TCS and other companies, and perhaps that's why we are seeing this correction take place in, IT stocks. Now,
okay, Avinash Gorakshakar has finally joined us. Avinash Gorakshakar, Director Research, Profitmart Securities. Avinash, good to have you. We understand you were juggling with some internet connection issues. Let's quickly run our viewers through what do we know so far, and Suyash has done the job of running us through the markets. Let's first take our viewers through markets. Markets, closed on a flattish note this afternoon. What are you making of the numbers and the commentary that is coming out from IT sector?
I think first of all, my apologies. I had a small internet issue, so that's the reason for the delay. First of all, as far as TCS numbers are concerned, I think the markets were not very much excited, largely because the performance was largely flat. If you look at the revenue, the operating EBITDA, only highlight of this quarter was basically the EBITDA margins, a slight improvement in the EBITDA margins, and definitely a reasonably good order book in terms of TCP. But I think clearly the market looked at the commentary, with a certain amount of negative, growth, considering the fact that the management was extremely cautious on growth coming in from the European markets, and most importantly, there was no growth kind of connotations to the overall tone of the commentary. So I think that's the reason the markets were not very much excited, even by the buyback, of almost 4,150 odd rupees, which was announced. The buyback has been pretty attractive. It's a large buyback of almost 17,000 odd crores. So I think, clearly now it looks as if the third quarter and the fourth quarter is also going to be extremely challenging. I would not be surprised that the markets would obviously be now looking at IT as a slightly, only as a value kind of proposition rather than a growth option. And that's the reason, despite such a good buyback and a very good dividend, the stock has not given this any kind of gain on the upside today. We believe that investors will have to wait for at least another 2 to 3 quarters before growth resumes again, because growth is more important than a sentimental booster like the buyback which has been announced as of now. So I think net we'll probably see better commentaries from Infosys and HCL Tech also today. My sense is that if this growth issue continues, then I think you're going to see IT sector underperforming for a reasonably long time going forward.
Now, Avinash, as we speak, Infosys numbers are also out. Actually, the profit figures has disappointed, and it seems it has come below the street's expectations. Whereas revenue, which was expected to be muted, was ahead of street expectations. In fact, it's about 2% ahead of the expectations. But reading at the numbers, the first draft of numbers, it seems that Infosys has cut its revenue guidance, at least the upper band of its revenue guidance. We saw that being a major overhang on the stock in the previous quarter when it cut it down from 4 to 7% to 1 to 3.5%. I think they have cut it down to the upper band to 2.5% now. How much of an impact do you see it being on the stock prices?
I think this is a big negative surprise because earlier in the previous quarter, as you rightly mentioned, when the revenue guidance was cut, the market took it quite negatively, and I think the same issue, if it is going to be repeated in the quarter going forward, then I think clearly it means that order wins are not getting converted, and execution is going to be a major issue. In fact, from the TCS commentary also, one thing was very valid, is that conversion into actual order implementation is now getting a very big challenge for Indian IT companies. So I think it's going to be negative for Infosys. My sense is that the market was not expecting this kind of negative surprise, and of course the profit number has been below expectations, but the commentary and the guidance which has been cut, I think definitely sounds that at least the next 1 or 2 quarters are going to be extremely challenging for Infosys.
Now, Shweta, let's just quickly look at the Infosys numbers here. Now, Infosys has, the revenue has gone up by about 6.72% on a year-on-year basis, whereas the expectation was, we'll see a 3% rise on a year-on-year basis. So, revenue figures have come in at just below the 39,000 crore mark at 38,994 crores in Q2 of FY24. We have also seen a good profit jump, on a year-on-year basis. On a year-on-year basis, it has actually beaten the street's expectations. The street was pegging the growth to be at about 2.2%. We are seeing a 3.17% rise, in profitability on a year-on-year basis. Also, the operating margins, although they have jumped, it seems that, they are muted. The street was expecting a 50 basis point jump on a, year-on-year basis or so, but we have only seen a 35 basis point jump. So, not too bad, but good numbers as far as, on a year-on-year comparison. So, Avinash, what's your first, initial reaction on the numbers? What's your big takeaway here?
No, I think, see, more than the numbers, if the commentary on the guidance is going to be negative, that is something which the markets should be little wary and be concerned about. I think the markets obviously look at the future, and I think if the guidance has been cut, then I think it definitely is a not sign. And I think more importantly, I think order execution out of the current order book plus new orders back are now going to be critical variables. Plus, I don't know what has been the attrition number. The attrition has also been a kind of a major issue for most of the larger IT companies. So my sense is, I know it would be at best be a market performer. I wouldn't expect this performance to result into some sort of a significant amount of re-rating for the stock. So I think, we have been telling our clients that at best to hold on to these stocks, but fresh buying at these levels, we have not, we don't advise, at least at current valuations.
Now, Avinash, also reading the brokerage commentary, it seems that, even though the companies have landed, large deals in the quarter gone by, but the revenue, because these are long duration contracts, is only expected to, trickle in and add to the growth of the company starting from FY25. So, what are your thoughts on that? Do you agree with these brokerages? And on the back of it, will FY24 finally be a washout year for IT companies?
I think it looks like that the year that is FY24 will be a very challenging year, and in terms of earnings growth, which is a very crucial number which the market tracks, I think earnings growth could at best be flattish for most of the IT companies in FY24. And as you rightly said, most of these companies have got large order books, but most of these are going to get implemented, from FY25 onwards. So I think there's going to be a little bit of uncertainty on these orders. In case these orders get delayed or typically get executed at a later stage, then I think they are going to actually result in a slower earnings growth trajectory for these companies. So I think, it's going to be a little cautious road forward, considering the fact that these companies have always played on the buyback and the cash positions, of these companies. I think what the market looks is the earnings growth and the growth visibility. So unless these, metrics actually come back again in a strong way, most of the IT companies, including Infosys, TCS, are going to trade in a very narrow range, and there's unlikely to be any significant, re-rating in the near term.
Avinash, one final question on as far as Infosys goes. The commentary will start trickling in the next few hours. What will be some of the things that you will be tracking from the Infosys, Q2 results?
I think outlook on margins. Secondly, what is the attrition levels? And third point would be, what kind of, execution of the current TCV orders which the company has got. And most importantly, do they continue to see significant headwinds in US and Europe? I think these would be the broader, kind of data points which I would be looking forward to. And obviously, in terms of, the revenue growth, any cutback in the dollar guidance would definitely be a negative surprise. So I would be looking at all these inputs, from the management side.
And Avinash, HCL Tech is another company that is expected to, announce it Q2 numbers, probably in the next few hours or so. But I want to talk about the stock price action. As far as a top 3 IT company go, the expectation on the street is that HCL Tech will outperform, at least as far as this quarter goes, both Infosys and TCS. But the stock has in fact been one of the worst performers. So what gives?
Yeah, I think broadly, HCL Tech has always traded at a discount to both TCS as well as Infosys. And I think in terms of numbers, broad street estimates point out that, this quarter could be slightly better in terms of margins, in terms of the revenue growth. But I think here again, the question is whether, the management is committed to deliver this, and where, they could probably sustain this growth in the next 1 or 2 quarters. Typically, the second half is supposed to be a much better quarter period for the companies in the IT space. And I think that is something which the markets would like to look at. See, more than the numbers, it's the commentary and the growth outlook which would be shared by the, management. And that is something which has been slightly, patchy for HCL Tech. So I think in terms of numbers, we don't, deny the fact that valuations are looking attractive. But again, whether these numbers could be sustained, any slowdown signals, signs, if have been highlighted by Infosys management, would obviously mean that the overall IT space is going to be challenging. It cannot happen that HCL Tech will grow and Infosys will not grow. So I think typically we'll have to see the, management tone of all these companies, and then take a call as to whether HCL Tech really qualifies as a buy. But currently, we have a hold on the stock.
So wait and watch mode as far as the IT pack goes.
Absolutely.
And all eyes will be on the management commentary.
And of course the guidance, because for Infosys, upper end of the revenue growth guidance has been cut by 100 basis points. In fact, margin guidance is same. It's been maintained at similar rates. Avinash, what are you making of as far as the guidance from Infosys is concerned at this point in time? And what sort of commentary would you be expecting from both Infosys and HCL Tech? What will be the broad parameters, indicators you'll be looking and watching out for?
As I said, the broader number which will be very much important is the dollar guidance. Any cutback in the dollar guidance is definitely going to be negative for both Infosys and HCL Tech. Secondly, in terms of margins, I think TCS has shown a slight bump up in EBITDA margins. Whether margins are going to be sustained or whether there would be some downward pressure. And thirdly, on the attrition side, has attrition now stabilized? And most importantly, what's the kind of business outlook, from key customer regions like US and Europe? Because US has been growing very pretty well, but Europe has shown a stodgy kind of growth. So I think all these points will be important. I think once we get the management commentary out, these things would be very important to note whether the management is upbeat, positive, or slightly cautious. If they give a cautious commentary, then I think it clearly means that, the third and the fourth quarter is going to be equally challenging.
All right. And, since we're talking about attrition, we know, with the way TCS and its guidance and its commentary, attrition for the quarter gone by has come down lower. But the number of people, the headcount has also reduced, which substantially hints at a hiring freeze. And that hiring freeze will of course span out perhaps in a positive territory. The freeze may go away because there are deals that these companies have been signed, they're mega deals, and in order to live up to those deals and the expectations, more hiring in pipeline.
And Avinash, given that these companies have landed these long duration multi-billion-dollar contracts,
You need
more talent, you need to retain more people, you need to hire more people as well, right?
Do you think hiring is going to happen soon?
No, I think my guess is, hiring will have to happen because these are all long gestation projects. But I think clearly, as I mentioned to you, that attrition has also been a major issue for almost all the large IT companies. If they manage to control the attrition level, then I think they are well positioned. In fact, TCS, as you rightly mentioned, the attrition level has been maintained. But I think going forward, most of the other IT companies continue to face challenges. Key talent is still not available, and whatever is available over a period of time. So I think it's going to be a key challenge even on the management, on the manpower side, because in IT the major asset is the manpower, and obviously they need to have skilled manpower to ensure that long gestation projects and long duration projects are serviced within timelines given by the customer. So we'll have to wait and watch and see what the management commentary on this aspect is also.
All right, Avinash, thank you very much for taking time out. Thank you for joining us on this very crucial day. We, of course, keep tracking all the numbers here on News 9. Remember, the earnings season has kick-started with TCS, now Infosys, HCL Tech results also awaited very, very soon today. We will keep bringing all those numbers right here on News 9. Thank you for being with us this afternoon. But shifting focus now to retail inflation, those numbers are also expected in some time from now. The retail inflation print for the month of September is expected to be released shortly. India's consumer price inflation or retail inflation for September is expected to come down to nearly 5.4 to 5.5%. That is the expectation, owing to a sharp decline in select food items, including vegetable prices and edible oil. Now, September retail inflation print is going to be within RBI's tolerance range of 2 to 6%, and that is what many people are saying, many economists are predicting after 2 consecutive months. India's retail inflation, remember, in July was 7.44%. In August, it came down to 6.83%. Will it be within RBI's range? Will it not be there? Let's discuss that. Indranil Pan, who is the Chief Executive Economist at Yes Bank, joining us on the show. Also, my colleague Krishna Kumar here in the News 9 studio. Indranil, I want to come to you first. Good afternoon, sir. Thank you for taking time out. What are your predictions, estimations as far as the September inflation is concerned? Will it be 5.4? Will it be 5.5? What's the broad range you're expecting?
Our own expectation is 5.4. It's absolutely the median of the range that we are seeing. And obviously, the various factors that you just mentioned in terms of the vegetable prices, the oil prices, the fruits, all that has actually sort of likely to lend a positive hand to the inflation. Furthermore, this is the month also when we factor in the reduction in the LPG prices, which is expected to lower the headline inflation by around 20 to 23 basis points. So all taken together, we should be looking at a 5.38 to a 5.4% in terms of our own expectations.
All right. And, you know, a lot has changed in the last couple of days. There is a war raging in West Asia, which is going to play up big time in inflation, the numbers that will come out perhaps from the ongoing month. There is a possibility of a recession-like situation. Fuel prices are inching up every day, you know, $5 up, $5 down. There's a volatility that continues, that persists. What are you making of how inflation globally with emerging markets as well as developing markets will pan out in this month and months to come?
Well, I think it's a very important question, though a very uncertain answer. As the current sort of crisis situation emerges, it is unlikely that you will have a larger number of players joining into the crisis, and it might actually stay localized within the Israel and Palestinian conflict, and we are not expecting either an Iran or a Lebanon to join in. Now, if the Iran or the Lebanon joins in, and if there is a problem in the closure of the Straits of Hormuz, through which the oil passes, and specifically to the Asian economies, that would be one of the bigger incidents that we can be looking at in terms of the negativities for the Asian economies per se. Having said, for India, we are holding the pump prices, and any increase in the prices of crude oil plus currency depreciation may not have a direct implication for the CPI inflation as we are holding pump prices, though it will have implications for a lot of other macro variables, including the fiscal and the balance of payments, but not on inflation per se, on a direct basis. However, on an indirect basis, because crude and crude derivatives are a significant portion of the WPI inflation, it needs to be seen whether some portions of that gets passed on to the end users, which will be an indirect implication in terms of the core inflation for the CPI.
All right. Yes.
If I were to add to that, we are also expecting the US CPI inflation data today. There is also the possibility that the inflation in US could be cooling from 3.7% to 3.6% on a year-on-year basis. At least that's what the street is expecting. Possibility of Fed rate cuts are being discussed. But at the same time, IMF has said that the only way the war could have an impact on global inflation is if it becomes a wider conflict that involves more countries. But if it's going to stay within Israel and Palestine, then there's a good chance that there will not be a wider impact on global inflation. Would you agree with that hypothesis?
Yeah, so I did mention the fact that at this point in time, we are working with a hypothesis that it does not escalate into many more countries joining into the conflict, and it remains an Israel-Palestine conflict, and then we are in the safe zone of, say, an $80 to $85 a barrel in terms of the oil prices, having also factored in some amount of slowdown implications from China and also the US. You're right that the US inflation is likely to be cooling off, but let's note that any cooling off in the inflation in US may not necessarily mean that there's a rate cut story on, simply because I think we are far away from the 2% zone in terms of what the US Federal Reserve is mandated on the core PCE basis. And unless they confidently and on a durable basis are moving towards the 2%, I don't think a rate cut is on, which necessarily means from the Yes Bank perspective and from our desk perspective, we are not looking at any rate cut in the US in 2023.
And coming back to India, we know if crude prices continue to inch up, they could play a spoil sport big time as far as CPI inflation in the ongoing month is concerned. What sort of impact are you expecting? Let's assume crude will inch up to $100 barrel and above. Will that have an immediate impact on inflation, or do you think the government is going to absorb that impact as of now?
So as I said, we are holding the pump prices. And to a certain extent, the additional taxes that we are collecting, the windfall taxes that we are collecting, could to a certain extent buffer the increased budgetary allocation that needs to be put out if we continue to hold the pump prices. Now, given an election year, I doubt whether the government would be willing to allow for an increase in the pump prices, which means that we would still continue to see relatively no direct impact of the higher crude prices globally onto the inflation in India. The only other implication is if the global risks were to turn out relatively more adverse. The question is whether we should be seeing relatively faster currency depreciation from an INR perspective, and that could add to the landed cost in terms of many other commodities, and that could have its implication for the headline CPI number rather than the crude in a direct way.
And when you say a 5.4% target or 5.4% expectation for the month of September, what are you factoring in? Are you factoring in the reduction in LPG prices and the lowered food prices as well? And is that likely to continue into the month of August and thereafter? And also, if you could run us through what are your overall expectation for the quarter gone by is concerned. Is it 6.4 in line with the government, or is it 6.6? Because if you average it out and 5.4% is the target for the month of September, the average comes down to 6.6%.
Yeah, so we are also looking at a 6.6, which is equivalent to the RBI's estimate. There were fears that the 6.6 may not be tenable from an RBI's perspective, but given the slide in the inflation that we have seen, and especially helped by the LPG price reduction of the government, we should be attaining the 6.6 if our estimate of a 5.4 is correct. Yes, we have factored in the LPG price decline, which I did mention that would be about a 20 to 23 basis points a downward implication for the headline CPI. We are factoring in vegetable prices drop, which has dropped again by almost a 20% in the month gone by, after a drop of close to 9.5% in the previous month. The only worry that we have at this point in time is the pulses prices, which is going up by 5% on a month-on-month basis for September. And given the lower acreage that we saw, a lower sowing that we saw in terms of the Kharif production, there could be some worries in terms of pulse prices going forward. Pulses also is significantly a Rabi crop, which necessarily means that given the lower reservoir levels, we could see some worry in terms of pulses, and that's something we need to factor in. Cereal prices is of course flat. It's about 1.1% month on month, both in August and in September. And immediately we don't have an implication of the El Nino, which has definitely led to higher cereal prices globally. But given the fiscal policies and the measures that the Indian government has taken in terms of in terms of stopping exports of certain commodities, we should be well buffered.
All right, and would you then agree with an overall FY24 target of 5.4%? Does that sound well? Is it within the limits that you're expecting?
So we in fact have a slightly shade lower estimate at 5.3%. So 5.4% as an estimate is quite good.
Okay, 5.4%. It looks good. There is a lower estimate of 5.3% in Indranil is what he said. So perhaps inflation within the ranges that RBI is expecting. As far as, you know, and before I let you go, I think it's also interesting to point out for the RBI to factor in the reduced inflation in the month of September and for the expectations for the month of October. What is your expectation on a possibility of a rate cut? Will the rate cuts therefore be within this fiscal year itself? Or is the expectation now that RBI could be looking at a possible rate cut, not waiting for the next 2 or 3 consecutive quarters, but perhaps within this year?
A rate cut scenario is definitely not on for 2023 and for the rest of the financial year till March 2024. Very specifically, the RBI has tightened the liquidity, which necessarily means that there is no indication from the RBI that they would be softening their stance on the tighter monetary policy. So that's number one. Number two, the interest differential between India and US continues to be quite low. And that could be a little bit of a worry in terms of the future when we are also likely to see bond inclusion into the bond index. So all those factors taken into consideration, I think one, we are still not very confident about the 4% in this financial year as also for the next financial year. FY24 RBI's own estimate is on a structural basis that inflation should be around 4.5% or so, and hence the 4% continues to elude. So it's an evolving story, definitely not for FY24 financial year. Our own desk, we are estimating a Q2 FY25 to be the first chance for RBI to actually reduce interest rates, assuming that by that time there are clear indications of slowdown in the US, and hence the market starting to at least price in rate cuts by the US Fed.
All right, so Q2 FY25, that is the expectation as far as a rate cut is concerned. Indranil, thank you very much for joining us on this very crucial day. Remember, inflation numbers are expected to be out very, very soon. We'll bring them right here on Newsline. Well, moving on now, the company Byju, which is in the midst of news, is back in focus. It is in midst of a rejig now and looking to sell its subsidiaries, Great Learning and Epic, to raise money and repay the $1.2 billion term loan B it raised from lenders in 2021. Now, news coming in that Byju's lenders have appointed the risk advisory firm Kroll to safeguard quote-unquote charged assets used as collateral to secure loan, allowing the lenders to seize them if the borrowers default. Now, sale of Great Learning and Byju's Singapore entity will be jointly carried out and coordinated by the edtech giant as well as its lenders. The startup is hoping to raise about $800 million to $1 billion from the sale of the two assets. Now, this comes at a time when 6 of Byju's biggest investors have constituted an informal working group to engage with the company and track its progress as well as provide suggestions. The group, which has now been formed, includes some of the largest investors of Byju, such as General Atlantic, Prosus, Peak XV, Sofina, Chang Zuckerberg, and more. The working committee comes 3 months after 3 key investors, board members, stepped down. Srinath Sridharan joining us on the show to discuss the Byju's ongoing saga. The saga, Srinath, continues. Lots of news items coming in from Byju's kitty this afternoon. But let's begin with the working group. Quite interesting. Months after the board members resigned, they are back. And this time in a capacity to advise. They formed a working group, a working committee, where they will be interacting with the management of Byju's.
I mean, I can't speak much about the governance expertise of the governance experts. Some of them did issue a book recently launched a book on governance, and yet they stepped down from those boards and today want to have almost influence on management decisions of this entity. So it's something remarkably startling. They're trying to protect their valuations or their assets on the equity side, and yet the same company has challenges on the debt side. And as we have spoken before, debt will reign supreme than equity. So if they can solve for the debt issues by paying off those debts, I think equity they can salvage. Otherwise, it's going to be impossible. And Shweta, I mean, how is it looking like? Today, if you look at the board, there are no major shareholders on the board, which means all these investors, none of them have a board seat. 2, there are no independent directors on the board. So it's literally almost like the 2 founders fighting the rest of the shareholders, and with the world watching and with people like us commenting, right? So it's very interesting is how are they going to actually salvage this situation? Governance or no governance, a business or no business, they need money. And the challenge is they now have a new CEO of sorts. They will bring in a new team. There is also conversation about in Great Learning, the management or the original sellers are ready to buy it back. So all these conversations are going to unfold, but there are no really answers. This has been going on for far too long, and this is not a easily monetizable asset. I mean, edtech, I mean, it's no more fashionable. They made it fashionable, and it is for their own reason that it is no more fashionable. Okay.
The one thing I want to ask you at this stage is this: there is that talk of those who exited the board, the investors who have exited the board, forming a consortium and sort of taking on Byju's. I want to understand how much of an impact do you think that's going to have on the proceedings and the recovery process of Byju's per se? Because let's face it, at the end of the day, we would all prefer that Byju's fixes all of its issues and finds a way back to good health, and let's go off all that's been plaguing what's been plaguing it so far.
So let's look at it, Krishna. Let's look at it from the regulatory framework. I mean, you as a shareholder, as an investor, sat on that board, and you said that I didn't know about a lot of these things that happened. My shareholding has come down, so I exited. Today, by sitting outside, it's almost like sitting on the fence and saying that I want to have a say in how this company is being formed, or I'm going to put pressure on the company. I mean, do you think it really is going to materialize? This is an unlisted company, a private company, and you don't even have a board seat. I mean, I'm assuming that these are going to be challenges because if the founders never listened to you when you were on the board, when it was your money, what is the change now that they should listen to you? So I think the optics of talking about working group, we did not know. I mean, somewhere smacks of poor governance, even from these investors, large investors who run large funds globally. I mean, just because I think we have very, very loosely worded regulations around unlisted entities, I hope that the Ministry of Corporate Affairs is going to tighten some of these. A lot of them get away. They simply said, our share SHA changed and we're stepping down from the board and we don't know what's happening.
Srinath,
So
they
I don't
are
think
planning
it's going to change
a huge set of new norms for the big unlisted companies and startups, the Ministry of Corporate Affairs. In fact, we have done a story on this on News 9 Plus, a documentary, and we are suggesting that those who are watching this broadcast should go watch the documentary on News 9 Plus about reining in the unicorns of the country. Talk to us from that perspective. Do you think Byju's is that a prime example on why there needs to be greater financial transparency when it comes to unlisted companies, which in India are these huge startups which have done so well for themselves in the last decade or so?
And Srinath, just to add to that, I believe cutting some slack for Byju's, we've done enough stories of when Byju's got it wrong. We've done enough stories of when they fought with their own board members, the board members resigned. Now we are looking at a rejig. We're also looking at a restructuring. We're looking at Byju selling some of its assets, trying to monetize its business, getting better at people management. There is a rejig at the top end from the CEO, the newly appointed CEO. Would you then think that things are changing and far shifting to a positive territory for Byju's? It has learnt its lessons. I mean, to be fair to them, at this point, it looks like they're doing everything they can.
So, Shweta, let's draw the analogy of the great Indian family businesses we have, right? I mean, the patriarch or the founder might say, I've stepped down. But just in this case, if you compare it with Byju's, they're far younger. And are they actually going to run non-executive roles? That's a larger question from governance point of view. Otherwise, nothing has changed. I mean, they still control, almost brute majority of the company. They run everything. The new CEO will still report to them. And the world outside the three of them will never know what's the truth. The truth is between the three of them. And by the way, this is not about Byju's at all. This is about every single private unlisted entity. So the challenge for Byju's here is really, can they quickly monetize? And that's the opportunity they also have. Two, I think the debt lenders have run out of patience. I mean, there is a case going on there. They've seized this asset. So if you don't solve for debt, equity is anyway a risky proposition. The equity investors always know that whatever they've invested can be written off to zero. I mean, that's the premise of equity as a risk capital. So I'm not even worried about the equity investors. What about the debt lenders?
Okay. The debt lenders are also, in the latest that we know, looking to help Byju's in selling, both Epic and Great Learning, because those are the plans that Srinath, Byju's has for repaying its debt, which is a massive debt of $1.2 billion. Do you think there is a concerted attempt therefore being made, lenders sitting with the management and saying, hey, let's arrive at a solution. We've fought for far too long, but let's arrive at a solution, an amicable one at that?
I mean, I'm not a social media guru, but I'm just punning on the word. It sounds epic and great learning. I mean, I hope the lenders don't end up with an epic great learning out of this. So I think the challenge for them is going to be, they may not get the value that they're looking to get back. They might get a part of that value. But having said that, global lenders always know that they're willing to take a haircut. I think that's
in your assessment, sorry to cut you short, in your assessment, do you think Epic and Great Learning will not give the massive returns that Byju's is expecting it to? $800 million to $1 billion, that's the estimate?
So I think today a lot of this is rhetoric. I mean, I think they're keeping the optics alive by talking about valuations. The market reality for EdTech seems to have completely and drastically changed. And as I said, they were the poster boys of success for EdTech, and they're also today the poster boys of what could go wrong in EdTech. So I think it is a challenging moment for them, no doubt. Irrespective of management change, they may not get the valuation they are seeking. But the larger question is, will then the lenders say they're okay with the haircut that they get and move away, or are they going to continue making trouble for them?
Okay, just to add to the puns that you were mentioning, there is also investor interest into Aakash from Ranjan Pai. So I guess sky is the limit as far as EdTech is concerned, even at this stage.
I mean, I think education, yes. I'm not sure about the ed tech part of it. I think that's a challenge what we have. We're still going back to that tutorial model, right? I mean, end of the day, the great Indian tutorials, the famous teachers in the local neighborhoods, again, seems to be the fashionable valuation. It's not those ed tech, unfortunately.
But you know, Ranjan Pai's, whatever money he's pledged so far, and this is by the way of news item that is breaking this afternoon. There's no confirmation from our side just as yet on that, but it will have some sort of moral boost at least for the company, for Aakash.
Yeah.
I mean, Shweta, I mean, nobody pumps in money for moral values, right, or moral obligation. It's for absolute financial return. And of course, governance being part of it, I'm sure Pai will bring in a lot of governance aspect there. But if they see value in something, we really don't know at what valuation, at what discounts, and what are the covenants. I mean, a lot of the, it's still a private company. So a lot of these could be private covenants that they will be giving. And I'm assuming that if somebody were to pump in money, they will actually ask for management change.
Yeah.
I mean, if they don't, I mean, I don't know how they
since we're talking about Aakash, there are plans of an IPO, so it may not be a private company. It may just become a publicly listed company soon, in which case Ranjan Pai will also get a seat at the table. But Srinath, we've run out of time. Absolute pleasure listening to all the puns this afternoon. Thank you very much for taking time out. And as we continue to track the Byju saga, there are fresh developments. Developments continue. We are given to understand that Aakash, a subsidiary of Byju, is also eyeing an investment of 300 million from Ranjan Pai. That money could come in very soon and change the game, perhaps, for Byju in the near term. But that is all we have on this bulletin. Thank you for watching.
GPT. It can generate codes and human-like responses through text, write stories, and do a lot more.
I work in a newsroom with anchors, researchers and scriptwriters, graphic artists, producers, video editors, camera crew. But does a newsroom really need them